Okay, accounting for bad debt expense using the allowance method. Um, I want to say this is probably the most intense lecture of this chapter, and for the most part, I think it might be okay. Um, and I'm going to go back and forth between the PowerPoint slides and my scribbling. But the allowance method, this slide's basically telling us that at the very end of the period, we're going to estimate bad debt expense for the future. And I'll show you what that looks like in a second. But by using the allowance method, by creating this bad debt expense in the current period, we're matching um, revenues with expenses, and we're also showing the net realizable amount that we anticipate collecting of our accounts receivable on the balance sheet. And I think that just makes more sense after we walk through some examples. Okay? So, too many words on this slide. Definitely too many words on this one as well. What was I thinking? Okay, so here we go. Let's say that during the year we had, I don't know, credit sales of $300,000. We would debit account receivable for 300,000, and then we would credit sales 300,000. Then let's say that during the year we collected $100,000 of that. Okay, so during the year we collected 100,000. It could be the case that we sell holiday gifts, and the vast majority of our sales don't occur until the very end of the year, right? No reason to get worked up about the ridiculousness of my example. All right, but we would credit accounts receivable. On our balance sheet, we would have accounts receivable. Initially, we put 300,000 in there. We then credited 100,000, and now we have 200,000 left. Okay? We're at the end of the year. Under the allowance method, okay, what we're going to do is we're going to say, hey, listen, I had 300,000 in credit sales. Of that, I was able to collect 100. We still are owed 200,000. Let me back up. Without worrying about how we're going to estimate the amount, let's just look at the structure of the journal entry. Let's just say that we employ this method. We do some analyses. I'll describe those in the next video. But we come to the conclusion that our bad debt expense in this particular period is $5,000. The journal entry to record bad debt expense using the allowance method would be bad debt expense 5,000. And now a new account that you haven't seen yet, allowance for bad debt. Credit 5,000. The allowance for bad debt is a balance sheet item. It's a contra asset, allowance for bad debt. And it is a contra accounts receivable account. On the balance sheet, for this particular company, we would show accounts receivable 200,000 and allowance for bad debt 5,000 for net receivable of 195. Okay. But by creating this allowance for doubtful accounts, allowance for bad debt, we are able to determine what the bad debt expense is going to be in the period that we made the sales. Okay. This is a great example of the allowance approach. Boom! I'm changing slides on you. I wanted to come back to this slide and I wanted to say it records bad debt expense in the period when the sale is recognized. So we just covered that. And then it reports accounts receivable on the balance sheet at the estimated amount of cash collected. And that is what I was saying. We have total receivables in my example of 200,000, 5,000 in the allowance, and therefore we anticipated only collecting 195,000. And you're going to crack up. I teach this class with a different book at a different college, and for the last 10 fucking years, I have called this account the allowance for doubtful accounts, okay? And then when I go into the homework, in the book that I'm using, I realize that our book in this other class is called Allowance for Bad Debt. And it's like, man. So in this lecture, I was like, I'm getting it right this time. It's called the Allowance for Bad Debt. And then as soon as I paused the video and came back to the PowerPoint slides, I was like, I cannot fucking believe it. The one time I get it right and it's wrong. Because this book uses the terminology that I'm totally familiar with. Okay. So regardless of whether it's allowance for bad debt or allowance for doubtful accounts, it's the same account and it's the same concept. It is the total amount of receivables that we anticipate not collecting. All right. So this was the book's example, right? So they have total accounts receivable of 20,000 and then allowance for doubtful accounts of 1,500 for a net amount of 18,500. You could also show it alternatively this way. Accounts receivable net of a 1,500 doubtful account, 1,850. But the important thing is that we are definitely showing the 18,500 is the real amount that we anticipate collecting, not the 20,000 that's actually in the T account. Look, we hope to capture the 20,000, right? But realistically, based on our experience and all the things that we know, that's just unrealistic. It's going to be the case that some of our customers, unfortunately, are not going to pay. And therefore, we report the net realizable amount on the balance sheet. Okay? So going back to the slides. So what happens when we are looking at a particular customer and that particular customer, we've tried and we've tried and we've tried, and there's just no way for us to collect the amount that this customer owes, okay? Let's say that, again, we have all of these subsidiary accounts, and one of the subsidiary accounts is accounts receivable for Heath, right? Something tells me that person would pay, but let's just assume he's a deadbeat and he's not going to pay. And in this subsidiary account, this particular customer owes us $100. Okay? And we have like tons of different subsidiary accounts, all with various amounts that people owe us. But the amount that rolls up into the general ledger is the 200,000. Okay. So let's say we write off, it's time for us to write off Heath. How does that look? Okay. What we are going to do is we are going to debit the allowance, and just to be consistent, for bad debt, it could also be allowance for doubtful accounts. That will be 100. And we are going to credit accounts receivable 100. Okay? I want to point out a couple of things. First, we do not recognize an expense at the time that we write off a customer. Okay? Right? The write-off is the second journal entry. Under the allowance method, we do not recognize the expense at the time of the write-off. We recognize the expense at the end of the period using the allowance account. Okay? So again, no expense when we write off a customer. And then if you really think about it, right? If you really think about it, in my particular example, in fact, my particular example, I've got too much information on my slide already. So I want to go to the PowerPoint slides real fast. PowerPoint slides are going to walk you through a write-off. And I just want to show you this particular scenario, okay? Before the write-off, right, we have total accounts receivable of 20,000. We have an allowance for doubtful accounts of 1,500, and therefore we have net realizable amount of 18,500. Pretty sure in our book the write-off is 520. Okay, we're saying, hey, listen, Kent isn't going to pay us. We're going to write them off 520. The point that I wanted to illustrate with the PowerPoint slides, we are going to reduce accounts receivable by 520, and we're going to reduce the allowance for doubtful accounts by 520. Remember, the journal entry to record a write-off is going to be the allowance for doubtful accounts, 520, and accounts receivable, 520. I'm lowering both of those. And here's the resulting amount. The original 20,000 minus 520 gives us 19,480 in the accounts receivable bucket. We initially had 1,500 in the allowance for doubtful accounts. We reduced that by 520. Now we've only got 980 in there. This is the important thing I wanted to point out. After the write-off, right? After the write-off, it's still the case that we anticipate collecting 18,500. It hasn't changed after the write-off. Because before the write-off, we were saying, hey, there's going to be some customers that don't pay. And then after the write-off, it's like, okay, well, those customers didn't pay. And we had planned for that. And therefore, when we write somebody off, it doesn't really change the net receivables amount. Okay, one last thing with respect to the allowance approach before we get into the details of how we estimate bad debt expense. Let's say we wrote off a customer. Let's say that we wrote off Heath. I don't remember how much Heath owed us. Maybe it was $100 in the last example. But our journal entry was allowance for, okay, I'm going to use the same terminology that the book uses for now on. Allowance for doubtful accounts. We debited 100, and then we credited accounts receivable, Heath, 100. Okay? So Heath no longer owes us any money. Individual's a deadbeat. This was the write-off under the allowance approach. Okay? All of a sudden, Heath gives us his $100. He pays. Crazy. So how do we record the recovery of an account that's been written off using the allowance method? Okay. So what we want to do is we want to put accounts receivable back on the book, $100, and then we want to put more money back into allowance for doubtful accounts. Turns out Heath isn't the individual that we're ultimately writing out. So we unwind the write-off. We're unwinding write-off. All right. Then we can record the receipt of cash. Then we can say cash 100 and accounts receivable 100. That's the allowance for doubtful accounts and the allowance method in general.